Welcome to Talk Tickers. Today, we're breaking down Vir Biotechnology's third quarter 2025 earnings call, which dropped just after the bell on November 5th. Let's get into it.
So if you're looking at Vir this quarter, it's really a tale of two completely different stories. On one side, you've got some really solid clinical execution, but on the other, you've got some pretty significant financial misses. The real question is, what did the market care about more?
All right, first things first, let's talk about the headline numbers. And listen, there's just no way to spin this. It was a pretty clear miss against what Wall Street was expecting.
Yeah, so earnings per share landed at a loss of $1.17. The street was looking for a loss of around 70 cents. So that's not just a miss, that's a big miss, a nearly 70% negative surprise. Ouch.
But honestly, the revenue number was even more shocking. Vir posted just $240,000. The expectation? Almost $2 million. That's a staggering miss of over 96%. It basically tells you there was almost zero commercial activity where some was expected.
But here's where it gets interesting. If you just look past those brutal consensus misses for a second and check out the year-over-year numbers, the net loss actually got smaller by more than $50 million. And that right there, that's our first clue that something else is going on under the hood operationally.
Okay, so let's dig a little deeper into those operations and, of course, the balance sheet. Because for a company like Vir, this is where management really wanted investors to focus.
And you can see why. They have been laser-focused on keeping costs down. Total operating expenses dropped by about $46 million compared to last year. And get this, they did that even while ramping up some major clinical trials. That's some serious expense discipline.
And all that cost saving means that despite the losses, they ended the quarter with a huge pile of cash, over $810 million. For a biotech at this stage, cash is everything. And that is a very, very healthy war chest.
So what does that cash pile actually mean? Well, this is the key. Management made it super clear that this gives them a cash runway, the time they can operate before needing more funding, all the way into the middle of 2027. That's the bedrock of their whole story. We have enough money to get us to our next major data results.
Okay, so now let's flip to that other side of the story, the clinical pipeline. This is where management is really trying to build a narrative of flawless execution. They're basically saying, hey, forget the financials, this is what you should be looking at.
And you know what? They've kind of got a point. They highlighted two big things. First, their main hepatitis delta program. They finished enrolling patients for a key trial 2 months ahead of schedule. That's a huge operational win. And second, their oncology platform, where they're pushing forward with programs for tough-to-treat solid tumors.
But, and this is a big but, look at this timeline. This really shows you the main challenge if you're an investor. The really big, game-changing data readouts? They're still a long way off. We're talking early 2026 for the first real oncology update, and not until the first quarter of 2027 for that critical hepatitis delta data. That is a long, long time to wait in the biotech world.
So you've got these two totally conflicting stories, right? Ugly financials now versus a promising pipeline eventually. So how did the market vote? Well, the stock's price action told the story pretty clearly.
The day after the earnings call, the stock closed down more than 5% and on higher than normal trading volume. To me, that says investors put way more weight on the immediate pain from the financial misses than on the long-term promise of the pipeline.
And this isn't a new thing either. This reaction really fits into a bigger pattern. Over the past year, Vir is down almost 39%. Meanwhile, the broader biotech sector, it's been pretty much flat. So yeah, the market has been skeptical for a while now.
This brings us to the next call, where we boil all of this down into our forward-looking rating. How do we see things playing out from here?
So here's how it all stacks up. The bull case? It's all about that fantastic pipeline execution and that rock-solid balance sheet. The bear case? It's focused squarely on today's terrible financials and that very long, very risky wait for any meaningful data.
So, after weighing the great execution against that long and risky timeline, we're initiating coverage with a market perform rating.
Look, you have to give management credit for how they're running the clinical side of things and controlling costs. But that long, quiet period before we get any real value-driving data, well, it keeps us on the sidelines for now. We think the stock is probably going to trade in line with the rest of the biotech sector until one of those big catalysts gets a whole lot closer. And finally, just a quick reminder that this is not financial advice.